Welcome to the Master's Certificate in Technical Analysis, Module 14. This video is about futures. Firstly, this module tells you an outline of what futures are and how they work. And then it goes on to tell you some basic strategies. Obviously there's a lot to futures, but we'll give you all the groundwork so you can decide whether it's a financial instrument that you may want to trade. A futures contract is quite simply a contract or commitment to buy or sell something at a specified date in the future for a specified price. It's like having a contract with a car dealer. You go and see your car and say, "No, I'd like it in red, not black," and the dealer says, "Right, in a week's time you're going to get it. Put in the deposit now and this is the price." And so you're settled on the price, you're settled on the date. And so that's not a futures contract as such. That's called a forward contract, because that's just an individual contract you two decided. A futures contract is standardized so it can be easily traded. So you have a standard quantity of goods, you have a standard date, and that allows you to trade futures contracts, but it's the same idea. First type of futures contract is for commodities, and they've been going well over a century. Commodities are things like agricultural products, growing corn or maybe beef. Last year I was in my farm and I called up a friend of mine who's a dairy farmer called Bill, who's bought 40 acres of alfalfa, and that's a high quality food for dairy cows. It's much better than hay. We get good quality milk out of it. And I grew it with him, and he could take all the alfalfa that I could produce and he'd pay me $65 a barrel. And that was for a forward contract. We didn't write anything down, we just know each other. And it was agreeing a price for something happening on the futures, and in this case we didn't agree on the price because that was something that depended on the weather and when it was harvested. It was another forward contract, but that's agricultural contract, and the same thing happens with the commodities market. How futures contracts started was not from any speculative point of view, even though that's what they're used for mostly nowadays, but it started from people who were reasonably sure that they were going to get a reasonable price for their crop if they planted it, spent time looking after it, fertilized it, and that costs a lot. And the producers were happy, and the end of the users, whoever were buying that crop, they were happy because they knew they were going to get an able supply to get an able and steady supply. They could agree up in advance, and they knew that they would supply and they won't have to go shopping around in the market. Speculation came in later, and they estimate that now there are only 4% of futures contracts that actually go through to delivery, and that's too much speculation. And of course we hope that there's money to be made where there's risk, so speculators would jump in there. But basically futures contracts weren't invented for that purpose. Until recently, when they started making financial futures contracts, which were more for just profit purposes. But because the futures contract is risk, there's risk, and that's maybe bad weather. In my case of alfalfa, it was raining for weeks before it was harvest time, and while the harvest would be rained on, so I had to wait until the next cut. I would have to cut and then throw it away, and then wait for the next cut to be able to sell it. So it's a risk because of the time factor, because it's a futures contract. So what you're doing is mitigating the risk for both sides, the buyer and the seller, by trying to get an agreement that mitigates that risk. But then I think that around in the 70s they started things that were a bit much more financially orientated, like the Forex. Like the currency, you had someone agree that in 6 months' time I'm going to give you £100,000 sterling and get that at a rate of $1.50 to £1 sterling, and someone might say, yeah, that's a fair price. And usually it's business that do this, because businesses sell things overseas and they buy from overseas. So they like to set their costs so that they're not exposed to the ups and downs of the market. So that's how currency exchange, or Forex, or Forex exchange came about in the futures market. But then there are other financial things like bonds. Treasury bonds can be bought and sold in the futures market. That's always a cash settled deal. It can be delivered, but it's rarely, very rarely delivered. But basically, there's a specification for delivery. That's it. So the 10-year Treasury bonds have to be bonds that are due between 6.5 and 10 years from now, and have $1,000 face value. But basically, bonds can be traded because bonds can go up and down in value, as we know, depending on the rates of interest, on the rates of the interest rates, and you can get interest rates futures as well, and which are direct prey on how interest rates go up and down. But the financial futures contract is on the indices like the S&P 500, and you can effectively take a contract. Say I think the S&P 500 is going up, so I'll take a futures contract for 6 months' time, and I should make money out of that, because up and up, whatever I can get out of it, whatever I can get it for now. Most certainly, in fact, is the last decade you can get single stock futures on one single company's stock. Usually it's 100 shares, which is a futures contract, but then again, this is a financial trade. You wouldn't get delivered of the shares, you would just get the cash difference if things go up or down. Whether you trade on the futures market, firstly, the reason that it's popular is you can trade on margin. Trading a margin means that you're paying a little amount, maybe 10 or 12% the value of the contract, in order to hold the contract. If only the full amount of the goods are payable, then the goods are delivered, then the goods are delivered on the delivery date or the expiration date of the contract in the future. But to hold that contract, you have to have your name on it. To profit from it, you just have to pay 5 or 10%. And that brings me to the topic of derivatives, futures and derivatives, as are several other things we are going to discuss. Derivatives just means that you get a value from something else, that you derive a value from something else, something that might be a stock price or it might be an agricultural price, the price of corn. But derivative is a very simple concept. It introduces the concept of leverage. You can use a little amount of money to control and have profit from a large amount of goods, and the futures is the first example we're looking at of that. The other thing with futures, as with other things, you have a mark to market every day. What mark to market means is that the price is updated to the market price every day. What does this mean to you? Well, it means that your account can go up and down. If the futures market value goes down, then you're going to lose money out of your account. If the futures market goes up, they're going to put money into your account. So mark is to the market is not important if you're on the winning side of the trade. If you have the stocks, you don't see that as winning until you sell your stocks. But for futures, you can see that and get that money before you sell. Or you can lose money even though you haven't sold and realized your loss, and that's the only thing you've got about the futures. For futures, the mark to market means that you can have a margin call, which means that they may want more money put into your account because of the things going down in value. This really is just the market's insurance in the event of defaulting on the contract. They want to see a certain amount of money deposit that would cover the losses. If your trade is losing, then they'll want you to put in more money, and you'll be wise to send in the money as they want it. Otherwise, they might liquidate your position and cement that loss for you. The other thing in futures, a lot of them anyway, is that they have limits, which means that the price can't move more than a certain amount every day. If the price varies up to the limit every day, then the exchange can say, well, we'll move up to that limit for the moment and we'll let it find its natural price. But usually they don't do that. Usually they just let it go up to the limit, and the trading on that day has been within that limit, and the next day it can go up again. Another, when the futures are set, obviously there are several dates. They're expressed in months because there's a certain date in the month that the futures become due. And so you can, by March or May, call a future, for instance, so that's an intrinsic in the futures concept. and that means that futures are different from shares. Shares you don't have to sell at any particular time. Futures you do have a certain drop of time at which you have to sell it, so you have to bear that in mind. Certainly you have to bear those dates in mind. For pricing futures, the market price of the futures. One way of pricing futures is called cash and carry, and this is a theoretical way of pricing futures for something that's not perishable, maybe for gold. For example, you could sell a contract, say in 6 months' time, and you would provide a certain amount of gold at a certain amount of price, and you can satisfy that contract by buying the gold right now and borrowing the money for the gold and paying interest on the money and paying for storage, obviously some secure storage. But for your set price, the market price right now, the cost of the interest and the storage that gives you the maximum price for the futures can cost right now, and at a higher price than everyone will be going in, doing cash and carry and keeping a profit. So that's one way you can get a feeling for what sort of price your futures can be and how they go and how they can go up. They can't go higher than the cash and carry price. A lot of other factors also come into the price with futures. Obviously with commodity futures you have the weather factors. How is the weather doing? What sort of weather forecast do we have? All that has a saying is whether the crop's going to be any good, so that comes in and can affect the price of futures after you hold the contract. Also there are seasonal factors. For example, as there are with sugar, when it's planted the price would usually go up because you don't know whether the weather is going to be good for the crop or be washed out and not worth very much at all. That way, when sugar is grown, the sugar can be from the sugar cane, because it comes from two things. When it's growing and maturing, then the price will go down as long as it's going to be a reasonable year. As they can see that the sugar is there, you can see the sugar is here, and as long as the price is going to be good enough, it'll probably go down. So seasonal factors, you have to research that. And in futures there are also long-term trends that might apply to say we have an index futures. If you see them going up next year, okay, that would be priced into the futures. And then demand. Obviously demand, if no one wants to buy your product anymore, then the futures price will go down. As a lack of demand falls the price. So all these factors come into the pricing futures. They're all the things you need to be familiar with when you're going to trade in futures. You have to look into the particular market of stocks and indices or foreign currency, or whether it's old traditional commodities that have been doing futures for many decades. Future strategies. Well, you can go long in futures, in particular say single stock futures. Instead of buying stocks, you can get futures contracts on those stocks. You'll only pay a margin which will only be a fraction, maybe 10% of the price of the stock, but you can benefit in the stock going up, and if you go long, obviously you can benefit when the stock goes up. Similarly, you can do short futures. Short futures do an advantage over going short on the stock because they're much more easily traded, more liquid. As you'll probably know, that if you go short on stocks, the broker has a right to close out your position if whoever you borrowed the shares from wants them back. So the broker could lose out on you if you can't find any of the shares to borrow. Whereas in short futures, there's no question on that open interest in short futures can be as much as anybody wants. As much as the shares, because there's just contracts and they're not actual shares, and that are being bought and sold. Another general futures strategy is when it comes in the option as well as spreads. Spreads just means a difference in price, and you may be familiar with spreads or spread betting. When you've got a buying price and selling price, and the spreads with futures or options, spreads as a strategy is taking out two contracts. This could be buy January S&P and sold March S&P, and you're looking for a difference between the two values to build up, and you get the difference going your way, then you'll make money, and if you get it going the other way, then you'll be making a loss. You could do spreads between two similar companies, Pepsi and Coke. You could say that I think Pepsi's got a better market plan this year. I'm going to go along Pepsi and short Coke. You don't care if soft drinks as a whole go up or down, because what you're going to be looking at is how one company is doing as opposed to that of the other. And that's a relative strength strategy, but it's a spread. It's a spread strategy where you're going to long one short and short the other. You could also go long on both if you find two stocks that go in opposite directions, for example. If oil prices go up and airline stocks go down because the stocks costs are higher and you're not making so much profit on the airlines, so they're negatively correlated, and you could go long on both and you'll still have a spread because you expect it to go in different ways. Also with futures you can go in something like narrow-based indices. And that's good because if you can see something like healthcare is doing well, which it has done quite a lot recently, you can get a health-based index you can go long on. So narrow-based indices, that's another strategy, another way to play futures. There's a lot of benefits that can be on pretty much anything underlying, so you can look at how the shares are going to perform and how you can use futures contracts instead. The only thing with futures is that you must realize that there's a date. If you want to stay in a position in futures on those shares, you just roll on the value of your March futures contracts to your May contract, and you can keep on rolling, but you may from May and so on. So you have to have that in mind, and there's a date associated with futures contract, and you should plan to have something in mind to do something about that. But otherwise futures, they just simply multiply up your gains and your losses, and obviously you have to be prepared for risk. You have to position size so you can deal with the risk of the trade going the wrong way. So that's the only caveat with futures. You're multiplying up what you manage to do on your trading days. Next module we'll be talking about options. Options are different from futures. Futures is a commitment to do that trade sometime in the future. Option, as it says, is just a choice. You have to buy an option, as it says there's a prenup. You're getting yourself an option on whether or not you can go through with that purchase in the future. But it's a way some people like to trade off bad options. You have a set amount of loss which is based on the option, but you have an unlimited gain. So unlike futures, you have limited loss when you buy an option, but you have unlimited gains. So some people like the secure feeling they get from options as opposed to futures. And it's a matter of a risk profile and how you want to do it. So I look forward to talking to you in Module 15 when we're going to go into the principle and the options for trading. Goodbye for now.